So, I was reading the latest forecast from the Mortgage Bankers Association, or MBA, and it's a bit of a mixed bag. It feels like a good news, bad news situation.
Oh, I love those. Give me the headline.
Okay, the headline is the economy is going to be sluggish for the next 3 years, like snail's pace. But home sales are actually expected to inch up.
Wait, usually if the economy's dragging, housing drags too. What's the catch?
The catch, or the savior really, is stability. The MBA economists think mortgage rates are finally going to chill out.
Define chill out. Are we talking 3% again?
In your dreams, think mid-sixes. They're predicting rates will stay in a narrow range between 6 and 6.5%.
Okay, so not low, but predictable. I guess buyers can work with predictable.
Exactly. But we can't ignore the macro stuff. They're saying there's a roughly 35% chance of a recession next year. That's not insignificant. What about jobs?
Unemployment is likely to tick up to about 4.7% in the first half of the year. So the economy is definitely cooling down.
Okay, so the economy is meh. But you said home sales are going up?
Yes, despite the sluggish growth, they expect home sales to break through the 5 million mark next year.
That's a psychological win. Where's that growth coming from?
Existing home sales are expected to surge nearly 7%, and new home sales should jump about 6.5%.
If rates are staying in the sixes, why the sudden surge in sales?
One word: inventory. Supply is finally growing in markets across the country.
That makes sense. For the last few years, buyers had zero options. Now there's actually stuff on the shelf to buy.
Exactly. More choices mean more transactions, even if the economy is slow.
Now here is the controversial part: prices.
Oh boy. Are they crashing? Soaring?
The MBA actually sees national home price appreciation turning negative in the second half of next year.
Negative? Meaning prices drop?
Yup, but Fannie Mae disagrees. They think prices will just cool down to about 1.3% growth. So pick your fighter.
It's wild how different those forecasts are. What about the Fed? Are they done helping us out?
Pretty much. The MBA says the Fed is reaching the end of its cutting cycle. They might cut rates just once next year.
So we definitely shouldn't hold our breath for a massive rate drop to save the day.
And there is a wild card here: the government shutdown.
Oh, right. How does that impact housing data?
The MBA explicitly mentioned that the shutdown is messing with the availability of economic data. So these forecasts are based on what they have, but the picture is a little fuzzy.
Great. So we're flying with slightly foggy instruments.
Even with the fog, the lending side looks busy. Purchase mortgage volume is expected to jump nearly 8% next year to over $1.4 trillion.
Wow. What about refinancing? Is anyone refining at 6.5%?
Surprisingly, yes. Refi volume is expected to grow 7%. They're calling it brief spells of opportunity when rates dip slightly.
So bottom line it for me. What does the next few years look like?
2026 through 2028 looks like slow, below-trend economic growth, but a housing market that is slowly healing.
I'll take healing over crashing any day.
Same here. Sales growing at 3% annually in 27 and 28. Slow and steady wins the race, right?